Identifying fair value gaps in the market is one of the easiest strategies to start making money. Inside of this video, you will learn what fair value gaps are, common traps that beginners make, and lastly, a simple plan to start implementing gaps inside of your own trading. So, what are fair value gaps? Gaps represent an imbalance inside of price action. Each imbalance inside of the market has to get filled. The way that the market works is an auction place between buyers and sellers. When there is a huge push in price in a certain direction, price must come back and fill that area because the sellers or buyers that were inside of that move want to get back in and make money. So if you see inside of this trade, there is a huge push right here. This huge push created a gap that is right in this area, and the market had to come back into this area, and the sellers who sold got back into the move and sold price back down again. We know that there is a gap when consecutive candlesticks form without wicking back into the previous candlestick. So on this chart that I have right here, price made a move right in this area. But as you can see, when it created this move, each candlestick that formed, there was a wick that wicked back into the previous candlestick. So there would be no gap here since each candlestick had wicked back. When looking at gaps, you always have to look to the left. Now, if you look at this chart right here in this zone, we see that price had that same move, but it left a tiny gap right in this area. And like we said, when price creates these gaps, it has to come back and fill it in because the way the market works, the buyers and sellers who made the move want to get back in and sell or buy again. So price came back, tapped into this move, filled in the gap, and then price rejected. Once the market fills in a gap, more than likely the price will reject. So on this chart, as we can see, there was a gap right in this area. The buyers who pushed the price higher and couldn't get into that move at first got into the move later on once price came back into the zone. Since we know that price has to either fill in the gap or reject once filling the gap, we can create a trading system around it. Gaps appear on every time frame, but the higher time frame is more reliable, especially when first starting out as a beginner. Knowing this, we would create a simple strategy for fair value gaps that you can use. So the action step is going to your favorite pair, whether that be gold, US 30, NAS 100, GU, preferably something that has volume and moves every single day, because the more volume a pair has, the more liquidity or buyers and sellers, and that means more gaps will be formed. Then start identifying gaps inside of the market. Wait until London or New York session open, and then go to the 15-minute time frame or higher and identify the gaps that form within the session. Watch how price reacts to these gaps. As we said before, price either will do one of two things: either fill in the gap or reject from that gap. Go on a Nebo account after this or a small live account and execute once you see price fill in these areas. Now, the first couple of times, do not execute any trades. Just identify these gaps inside the market, because when you're a beginner, your mind has to get used to seeing price action move in this way. But once you see the pattern happen a number of times, you'll get used to it. I can give you this guide, I can give you these videos, but you have to put in the work and see these things happen on a daily basis. A common mistake that beginners make, though, is not choosing the right fair value gaps to execute on. The market is all probability. Choose the areas that have the best chances of success. Like I was saying with the higher time frame, a lot of beginners will go to the lower time frame, where that'd be the 1 minute or the 5 minute, and start looking for fair value gaps. These gaps will not hold as much because more than likely there isn't enough liquidity or buyers or sellers that can push the move higher or lower. An example would be this trade. This trade is a trade that happened on the 5-minute chart on AUD USD. As you can see, there was a fair value gap. Price created this huge push. And what does price do? We say that price can either fill in the gap, which it did, or once it fills it in, it rejects. This time, if you would have waited for price to reject once it filled in the gap and gotten in, you would have lost. Why? Because there were other events happening that went against the confluence or the reason for that gap to even hold. These buyers or sellers who pushed this move higher did not want to get back inside of the move and push it again because of different events happening inside of the market. So the main thing when choosing gaps is you want to choose the most high probable ones, combine it and stack it with different confluences. That to do that, I will make new videos in the future that more confluences you can use inside of your trading, that you can stack up your edge inside of the market. Because just trading gaps alone, yes, you can make money, but you need other things as well for it to be a truly, really good strategy. So if you guys like this video, make sure to subscribe for more content. And if you want to see me trade or see how I look at fair value gaps every day inside of the market, you can join Secret Traders University, which is down in the description.